Welcome to the Eggs Invest podcast series, where we explore smart, practical strategies for successful residential property investment across the UK. I'm Anna, your host here at Eggs Invest, and today we're going to talk about some of the most important, but sometimes overlooked pieces of the investment puzzle: how to preserve your property assets and grow their value over the long term. We'll be covering key legal structures and regulations you need to understand, how to navigate tax implications, and the best due diligence practices to keep your investment solid and thriving for years to come. Let's start with the legal side of things, because owning property here in the UK means understanding a web of rules and regulations, and how you hold your investment really matters. There are different ways you can own property: personally, jointly, or through a limited company. Each option comes with its own legal responsibilities and tax consequences. For example, owning via a company might offer some tax benefits or liability protections, but it also involves more paperwork and compliance. Being clear on these structures upfront isn't just about ticking boxes. It's about setting yourself up for smooth management and protecting your wealth down the road. And speaking of rules, the UK has specific property laws and regulations every investor needs to know. From tenancy agreements to safety certifications to the latest landlord licensing requirements, compliance is key. Ignoring these isn't an option. Failing to comply can result in fines or even losing the right to rent out your property. So, staying updated with the law and seeking professional advice when needed is a smart move. Next up, taxes. It's probably not the most exciting part of investing, but it's one of the most important. How you manage tax can make a big difference in your overall returns. When you invest in UK property, you need to be aware of different taxes like stamp duty, land tax, SDLT, on purchase, capital gains tax, CGT, when you sell, income tax on rental income, and possibly inheritance tax down the line. The good news is there are legal ways to optimize these taxes. For instance, using allowances, timing sales strategically, or structuring ownership through companies or trusts can reduce your tax burden. But it all starts with solid due diligence, making sure you understand what you're signing up for before you buy. That means digging into all the costs, potential tax liabilities, and long-term financial implications. Due diligence might sound like a boring phrase, but it's really the backbone of a successful property investment. It's not just about checking the physical condition of the property. It's about going through every document, contract, and financial detail with a fine-tooth comb. You want to ensure titles are clean, there are no hidden liens, planning permissions are in order, and that the seller is legitimate. In the UK, some of the key documents include the title deeds, energy performance certificates, tenancy agreements, and surveyor reports. Having all these in order and well organized means fewer surprises after purchase. Good record keeping also helps you keep track of expenses, rental income, and any communications with tenants or professionals. It's a habit that pays off big time when it comes to tax filings or selling the property. So how does all this legal, tax, and due diligence stuff help with long-term growth? Well, think of it like building a strong foundation for a house. You can't just hope your property will appreciate over time. You have to actively protect it from risks and optimize your returns. Keeping your investments legally compliant avoids costly fines or forced sales. Managing tax efficiently means you keep more of your earnings. And thorough due diligence helps you avoid bad deals that could drag down your portfolio. Plus, when you have clear records and structures in place, it's easier to make smart decisions, whether that's refinancing, expanding your portfolio, or passing assets on to the next generation. To wrap up, if you want your residential property investments in the UK to truly grow and stand the test of time, you need to think beyond just buying and renting. Understand the legal frameworks and compliance rules, get ahead of your tax obligations and planning, and commit to solid due diligence and record keeping. These aren't just admin tasks. They are key parts of a strategy that protects your wealth and helps it grow steadily. Thanks so much for listening today. I hope this gives you some clear ideas and confidence to approach your property investments with a long-term mindset. If you found this episode useful, don't forget to subscribe to Eggs Invest and share it with anyone else who's looking to build a better future through property. I'm Anna, and I'll be back soon with more practical tips to help you succeed in the UK property market. Until then, take care and happy investing.